Bernard Baruch delivered the line with the casual confidence of a man who had watched fortunes evaporate while his own grew stronger. I made my money by selling too soon. To most Wall Street ears, it sounded like an admission of failure, a confession of missed opportunities and premature exits. But Baruch understood what others refused to accept. In the brutal arithmetic of bear markets, leaving money on the table wasn't timidity. It was survival insurance. The lesson crystallized across 3 devastating market storms that defined his era. During the 1907 panic, when trust companies crumbled overnight and call money spiked to crushing levels, Baruch's early exits positioned him with liquid capital while others faced margin calls and forced liquidation. The 1920-21 deflationary bust punished over-leveraged speculators with surgical precision, shrinking earnings and collateral simultaneously until the mathematics of debt became unbearable. Then came the ultimate test, 1929-32, when the Dow surrendered 89% of its value from peak to trough, transforming paper millionaires into cautionary tales. Baruch's genius lay in inverting the game most investors played, while others chased perfect timing and maximum extraction, desperately trying to capture every penny of a bull market's final surge. He systematically converted paper gains into purchasing power. His willingness to accept 70% of a move rather than gambling for 100% created 3 decisive advantages. Cash became a strategic weapon. Rather than dead money, leverage couldn't compound his losses during crashes, and his psychology remained stable when headlines screamed that prosperity was permanent. This wasn't about lacking conviction or missing opportunities. It was about understanding that wealth compounds across complete market cycles, not individual trades. Bear markets don't merely lower prices, they systematically destroy the unprepared, turning temporary bull market heroes into permanent casualties. Baruch survived and thrived because he carried financial shelter before the storms arrived, not because he could predict exactly when thunder would strike. Baruch never treated a bear market as a mysterious force of nature. He approached it as a surgeon studies anatomy, recognizing that financial storms followed a predictable 3-stage pathology that destroyed wealth with mechanical precision. The first symptoms appeared not in falling prices, but in the credit markets where money itself became scarce and expensive. He watched lending standards tighten like a tourniquet, transforming yesterday's prudent leverage into tomorrow's fatal burden. The 1907 panic demonstrated this credit contraction with brutal clarity. Trust companies that had operated as pillars of financial stability suddenly discovered their loan portfolios contained risks their models had never contemplated. Call money rates spiked from comfortable single digits to crushing double digits almost overnight, and businesses that had thrived on borrowed capital found themselves scrambling for liquidity that no longer existed at any reasonable price. The market's outer veneer still gleamed with prosperity, but Baruch recognized the inner dehydration spreading through the financial system's arteries. Credit contraction inevitably triggered the second stage, liquidity cascade. What began as prudent selling transformed into mechanical liquidation as margin calls created their own relentless momentum. During the 1929 crash, Baruch observed how forced selling overwhelmed any attempt at fundamental analysis. Volumes surged dramatically on declining days while advancing days showed anemic participation, a technical divergence that signaled effort without corresponding results. Brokers' phones rang not because investors chose courage or fear, but because loans demanded immediate payment regardless of market conditions or personal conviction. The final stage arrived as capitulation, where even quality assets traded at prices that defied rational analysis. By 1932, profitable companies with strong balance sheets sold below their net cash positions, not because their businesses had failed, but because selling pressure had become completely divorced from underlying value. Dividend cuts outpaced price declines, and good assets traded alongside bad ones in the exhausted final phase of wealth destruction. Baruch's advantage emerged through recognizing these stages early rather than predicting their precise timing. He tracked widening credit spreads like a physician monitors vital signs, noting when heavy selling effort produced diminishing downward results and watching for leadership rotation from speculative darlings to defensive stalwarts. His systematic preparation allowed him to navigate each storm not through prophecy, but through disciplined observation of patterns that repeated with human regularity across different market cycles and economic environments. Baruch's doctrine did not arrive as inspirational slogans posted on brokerage house walls. It crystallized through expensive mistakes he refused to repeat twice. In the privacy of his study, away from the market's daily theater, he methodically rebuilt his approach around principles that could survive contact with human psychology under extreme stress. Each rule emerged from real capital at risk, transforming abstract market wisdom into operational procedures that functioned precisely when rational thinking became most difficult. His systematic rejection of tips and market gossip evolved into something far more rigorous than mere skepticism. Baruch constructed his own intelligence network through direct relationships with industry executives, comprehensive analysis of annual reports, and careful tracking of economic indicators like freight car loadings and commodity flows. While others chased, whispered recommendations that arrived, pre-digested and often pre-corrupted, he insisted on primary sources that revealed the underlying business reality, rather than market sentiment's latest mood. When positions moved against him, negotiation was not permitted. He established predetermined stop-loss levels between 7 and 12% before entering any trade, treating these thresholds as mathematical absolutes, rather than suggestions subject to hope or stubbornness. Small losses became tuition payments in his ongoing market education. Large losses represented expulsion from the game entirely. This discipline extended beyond individual positions to his entire capital structure, where he maintained debt-to-equity ratios below 25%, even during the most euphoric bull market phases. Baruch treated leverage like dynamite, potentially powerful but requiring strict control and careful distance from anything he couldn't afford to lose. Cash occupied a strategic role in his portfolio architecture, not as idle money awaiting deployment, but as a reserve of optionality that became most valuable precisely when others viewed liquidity as wasteful. During late bull market phases, he systematically accumulated cash positions reaching 40 to 60% of his total portfolio, understanding that purchasing power concentrated when fear replaced greed. His approach to position sizing reflected the same mathematical precision. Rather than diversifying across dozens of securities he couldn't properly monitor, Baruch typically concentrated on 6 to 12 carefully selected positions. This focused approach allowed him to maintain intimate knowledge of each company's competitive position, management quality, and financial health. He preferred what he called a small garden he could weed daily over a vast field he couldn't patrol effectively. The most controversial element of his doctrine, selling too soon, followed naturally from this systematic framework. He scaled out of winning positions at predetermined levels, converting paper gains into realized profits before greed could override judgment. This wasn't timidity, but mathematical recognition that capturing 70% of a move with certainty outperformed gambling for 100% with uncertainty. His buying discipline mirrored this patience, accumulating positions in stages as market conditions and credit signals confirmed that the worst selling pressure had exhausted itself. Periodic review anchored his entire system through formal portfolio assessments every 10 to 15 days, regardless of market conditions or personal conviction about current positions. These sessions forced objective analysis when emotions ran highest, measuring assumptions against fresh facts and retiring ideas that reality had proven wrong. Above all, he enforced emotional distance from his positions, recognizing that markets rewarded systematic discipline over brilliant intuition, and that his rules existed primarily to keep his judgment intact when crowds lost their collective sanity. The test of doctrine arrives not in classroom theory, but in the crucible where fortunes evaporate and nerves shatter beyond repair. Baruch's principles faced their baptism during 3 successive market storms that separated systematic preparation from wishful thinking with mathematical brutality. The 1907 panic struck when trust companies discovered their loan portfolios contained risks that comfortable models had never contemplated, while call money rates spiked beyond sustainable levels and collateral lost its elasticity overnight. Baruch had already trimmed exposure during the preceding months, not through clairvoyance, but because credit conditions had begun tightening, and prices no longer advanced on genuinely positive news. When the scramble for liquidity transformed orderly firms into forced sellers, he possessed the dry powder that others desperately needed but could no longer obtain. His methodical accumulation of railroad bonds and steel company shares at fire sale prices demonstrated how systematic deleveraging during euphoric phases created purchasing power precisely when quality assets traded below intrinsic value. The recovery validated his preparation through substantial profits that rewarded patience rather than prophecy. The 1920-21 deflationary bust demanded different tactical flexibility within his strategic framework. As post-war economic adjustments collided with monetary tightening, creating a deflationary spiral that caught leveraged speculators completely unprepared, Baruch resisted the temptation to declare premature bottoms based on price alone. He waited for concrete evidence that credit markets were genuinely healing rather than merely pausing in their contraction, letting businesses prove they could finance operations without heroic assumptions before deploying capital systematically. The 1929-32 catastrophe provided his ultimate vindication. Throughout 1928 and early 1929, while newspapers celebrated perpetual prosperity and margin buying reached unprecedented levels, he quietly converted enthusiasm into cash according to predetermined protocols. His systematic selling drew criticism from observers who measured wisdom by short-term performance. But when the crash arrived, apparent conservatism transformed into aggressive opportunity. His tactical short positions during the initial collapse, followed by patient accumulation during 1932's capitulation, demonstrated the full integration of his approach. The gains that followed proved that wealth accumulated through repeatable processes rather than heroic individual decisions, validating systematic discipline over brilliant intuition when capital faced genuine existential risk. The distance between understanding Baruch's doctrine and executing it under genuine market pressure resembled the gap between studying surgical procedures and maintaining steady hands while operating on a living patient. His principles demanded transformation from intellectual framework into operational choreography, where human psychology threatened to sabotage the most elegant strategies through fear, greed, or simple impatience. The conversion required systematic preparation that anticipated emotional failure before it arrived at the portfolio's doorstep. Baruch structured his approach around acknowledging that market conditions demanded different psychological responses across distinct phases. During late bull market euphoria, when optimism reached infectious levels and prices seemed to validate every bullish assumption, he forced systematic cash accumulation toward predetermined targets between 40 and 60% of total portfolio value. This occurred gradually through methodical profit-taking, rather than dramatic exits, converting paper wealth into purchasing power, while others celebrated unrealized gains. Every existing position received predetermined stop-loss protocols, typically 7 to 12% below entry points, removing negotiation from future loss-cutting decisions. When execution arrived during market dislocations, capital deployment followed predetermined tranches tied to objective signals rather than subjective comfort levels. He watched for capitulation volume patterns where heavy selling failed to produce corresponding price declines, monitored credit spreads for genuine stabilization, and tracked insider buying as evidence that informed participants recognized emerging value. Position sizing became his primary psychological management tool, limiting individual investments to maximum 1% risk levels, allowing rational judgment to survive even violent price movements against specific holdings. The management phase demanded perhaps the greatest emotional discipline, as recovery phases triggered human instincts to either hold positions forever or sell everything based on daily fluctuations. Baruch's predetermined profit-taking levels removed these binary decisions from emotional territory, systematically converting volatility into realized gains through multiple smaller victories rather than gambling everything on perfect timing. Regular portfolio reviews every 10 to 15 days created systematic checkpoints that prevented hope from overriding evidence or fear from paralyzing necessary action, recognizing that successful bear market investing rewarded systematic discipline over analytical brilliance, requiring courage when others panicked and patience when others rushed toward premature conclusions. Baruch understood that the chasm between theoretical knowledge and practical execution widened dramatically when actual capital faced genuine market storms. His 90-day framework emerged not as rigid prescription but as flexible architecture, acknowledging that bear markets tested human psychology as ruthlessly as they challenged financial positions. The system demanded transformation from intellectual understanding into operational discipline, where predetermined responses replaced emotional reactions and systematic preparation outweighed brilliant improvisation. The initial 30 days required what Baruch termed strategic retreat, a discipline that violated every investor's natural impulse to act decisively when portfolio values declined relentlessly. This recognition phase prioritized assessment over action, forcing systematic cash accumulation toward predetermined targets between 40 and 60% of total portfolio value. The process occurred through methodical profit-taking rather than panicked liquidation, converting paper wealth into purchasing power, while others watched unrealized gains evaporate. Stop-loss protocols hardened from suggestions into absolute orders, removing negotiation from future loss-cutting decisions when emotional attachment threatened rational judgment. New investments ceased entirely, allowing market structure to clarify beyond subjective interpretation, while intensive fundamental analysis began identifying quality companies that selling pressure had divorced from underlying business reality. As the second month progressed, positioning replaced paralysis through carefully measured initial stakes in highest conviction opportunities, demonstrating relative strength against broader market weakness. These test-sized positions served as market reconnaissance rather than major commitments, allowing systematic evaluation of how individual securities responded to continued pressure. Credit markets received constant monitoring for genuine stabilization signals rather than temporary pauses in deterioration, recognizing that authentic recovery would manifest first in the financial system's underlying plumbing. Strict position sizing discipline prevented any single decision from threatening overall portfolio survival, while meticulous documentation created accountability that would later reveal which judgments proved sound and which reflected emotional contamination of rational analysis. The calendar imposed its own rhythm, with weekly reviews measuring assumptions against fresh evidence and monthly assessments, evaluating whether market conditions warranted tactical adjustments. The final 30 days permitted more aggressive accumulation as market mechanics shifted from pure liquidation toward selective opportunity recognition. Successful positions showing constructive price action despite broader pessimism earned additional capital through predetermined tranches, while laggards faced elimination without sentiment or hope influencing the decision. Partial profit-taking began systematically on positions generating 15 to 25% gains, recognizing that bear market rallies could reverse quickly and that realized profits always outperformed paper wealth during uncertain conditions. This phase acknowledged potential false starts and secondary tests of market lows, maintaining flexibility while adhering to systematic principles that had guided the entire process. Throughout every phase, the operational rhythm remained constant. Weekly portfolio reviews prevented daily volatility from overwhelming long-term perspective. Monthly strategy reassessments measured tactical execution against strategic objectives, and quarterly doctrine compliance audits ensured that market pressure hadn't corrupted fundamental principles. Baruch's ultimate insight transcended tactical specifics. Wealth accumulated through consistent application of proven principles, rather than heroic individual trades or perfect market timing. Control emerged through meticulous preparation rather than futile attempts to predict unpredictable outcomes, proving that systematic discipline consistently outperformed analytical brilliance when financial survival hung in the balance.